In today's video, I'm going to be giving you the chartered accountant's method to building a multi-million dollar property portfolio. Now, my name's Luke and I run a buyer's agency here called Purpose Property. And my background is as a chartered accountant. Many years ago, I used to be an auditor for a mid-tier accounting firm here in Brisbane, but I branched out into commercial accounting and eventually into starting my own business here at Purpose Property. So the exciting thing today is I'm going to be able to give you a free property investment calculator. I'm not just going to be able to give you that, I'm going to walk you through the calculator today and share with you how Emily and I were able to build a multi-million dollar property portfolio by running these exact numbers. So let's just dive into some data, show you how you can get your hands on this calculator and walk you through the process. So the first thing I'm going to need you to do is head over to purposeproperty.com.au. So as you can see here, you're on our website, and if you scroll all the way down to the bottom, you'll be able to find the investment property calculator details. So click this button, download the free property investment calculator. So you can type in your details here and click download now. Then all you need to do is click this download link button, so property investment calculator here, and it will pop up in a new window. So now you've got the download, you can either import this into Google Sheets, which is what I like to use, or you can open it in Excel yourself. Amazing, and this is it. This is our free property investment calculator. You can click the link here to watch the original video around the calculator, but this is going to be an updated version giving you my current thoughts as a chartered accountant and a property investor and a director and buyer's agent here in Southeast Queensland, breaking down how Emily and I would be able to use these numbers to build a multi-million dollar property portfolio. So what I like to do is have the property details and history at the top. The example we went through last time was 80 Dyke Street in Mount Gravatt East, which is on the south side of Brisbane. It was a block on 615 square meters, 3 bed, 2 bath, 5 car, and at that point in time, it had a taxable land value of $450,000. Now, if you want to find the current land valuation, this is a bonus tip. You can type in annual land valuation on Google and find the annual land valuation for the property you're looking for. So by entering the details in this cell below, so we'll take this property's address at 80 Dyke Street, put this in here, take out some details so it can actually find the property. And as you can see on screen, if you're able to type in the address for the property you're interested in, you can see the current land valuation as of the 1st of the 10th, 2022 is $620,000. So you can plug that into your calculator. Now, the reason it's really important to know the taxable land value for your property is it's one, allows you to compare between properties, so different size land, different locations. What does the government say about that land value? And number two, it allows you to do something very important, which is that chartered accountant mindset, which is what is the land tax going to be in the future? And how can I minimize land tax legally, of course, to essentially try and pay zero land tax in the state I'm in? So in this example, I know from memory that the land tax thresholds in Queensland are $600,000 per person. So if you were to buy this property, your taxable land value would be $620K, and that would actually tip you over the land tax threshold here in Queensland, and you need to start paying land tax. So just be wary of that as well. You also want to make sure you do a flood search on the property and see whether it's got granny flat potential for your situation. Now, let's get to some of the deal analysis. So in the deal analysis, we want to run the numbers to get comfortable with a property purchase, understanding its current value and how we can add value to the property in the future. So this gives you places to fill out. So in orange, you can fill out the cells, and the blue cells are automatic calculations. So let's say this property is currently worth $950,000. The solicitor's fees might be $1,500. The stamp duty's been calculated at $35,000, so you can check that. We might do a building and pest for $700 and have a mortgage or title check of $500. So that means our total property costs. We also might have a buyer's agent. Let's say it costs, $16,000 for that. The total cost to buy this home for $950K, including closing costs, could be $1,004,000. So initial repairs and renovations could be 30 grand, and we'll get into that soon and how you can get a 2-for-1 return in manufacturing value. But all in all, you need to look at the total costs involved with making this purchase. So the total funds required will be $1,034,000 because you've got your renos plus all the other costs. Your home loan amount is calculated off to the right, and then you've got to look at some fees and some initial cash outlay. So this is how the funding is calculated off to the right-hand side. So this shows you for $1,034,000 required, you might want to put down a 20% deposit of $190K. It will then calculate that you need a bank loan of $776,000. Now, the interest rate of 3% is going to be very unrealistic at this point, so you might want to put in 6.5%. And that'll give you a bank LVR of 82%. So you can play around with the numbers to make sure it stacks out to what you want to see. You can then talk about a revaluation expectation. So let's say, we want to get a bank valuation and we want the bank valuation at $1,075,000 once we've done the work on the home. That means you potentially be able to refinance $860,000 worth of debt and then cash out another $83,000. Now, if you're a beginner investor or you're just getting into the property market, that might have been a whirlwind of information. So make sure you go back and watch it again. But all in all, what this calculator does is it gives you all the costs on the way in and then how you're going to fund those costs, whether it's from bank debt or your own cash, and allows you to manipulate the numbers to look at the different scenarios. This is exactly what I do as a chartered accountant and a property investor myself. I run scenarios. I run what happens if I put a 5% deposit down, a 12% deposit down, which is generally the sweet spot for LMI, or a 20% deposit down, and the interest rate is reduced from 6.5 to 6.2%. So you need to make sure you understand the numbers to help you make an educated and an informed decision. So let's take a look at the profit and loss because we've gone through the purchase or deal analysis. Now let's take a look at the running costs of the day-to-day and the week-to-week and the year-to-year for this type of purchase. So wearing my chartered accountant hat, we want to break down all those details for the profit and loss here on screen. So let's say this property rents for $800 per week, and we think it's going to be rented out 50 weeks of the year. That's a 96% occupancy rate, and that would be generating $40,000 a year of gross income. The gross rental yield on purchase price is 4.21%. Now, the higher the property purchase price here in Southeast Queensland, the lower the yield is generally going to be. If you buy $1 million home, it might have a 4% yield. Whereas if you buy a $700,000 home, it might have a 4.5% yield. Whereas if you buy a $500,000 home, you might have a 5.2% yield. So the yield percentage will generally increase as the property price decreases. The reason is you're generally paying more for the land as your property prices increase between different assets. And when you're paying more for the land, you don't generally get the same increase in rental yield as that property price increases over time. So look at the balance of purchase price to yield to help you make a decision on different assets and what you need in your property portfolio. You might be willing to accept a 4.2% gross yield on purchase price in terms of the cash flow if the property has some really strong growth potential. Whereas you might actually want a 5 or a 6% gross yield, but you're willing to accept a lower growth potential in that circumstance. So you need to find a balance between capital growth and cash flow for this specific purchase and how this property fits into your wider property portfolio. There's also some additional calculations here on the yield, but we're going to dive into some of the expenses first. So here you can fill out a range of different expenses when it comes to holding and owning an investment property. There's a whole bunch of categories that you can put your own numbers in to allow you to run these numbers. And that will give you the total outgoings to hold this investment property across the year. This does not include principal repayments. It's just expenses associated with this investment property. So the income is $800 per week and the weekly outgoings are $1,114. Now, I'm not going to run through this section today because I don't want to be giving out tax advice, but this is a template that Emily and I use ourselves to run the numbers for our own tax effect accounting. It's just a guide and you're obviously take this yourself and run your own calculations, but here you could put in your own numbers in terms of your income, the ownership of the property, what tax deductions you might be able to claim, and look at the tax effect accounting for holding and owning an investment property. Now, to jump back to where we were before around the net yields and the net income, you can see here the net yield excluding interest on this property is 3.43% or $32,000 a year. And when you take into account all income and all expenses, it's minus $17,000 a year before depreciation and tax benefits, which is minus 1.89% a year or minus $345 per week. So essentially before tax benefits and before depreciation, this property with these numbers, buying for $950,000, renting for $800 per week will cost you roughly $345 per week to hold. Now, looking at a scenario where both of you are on $80,000 of income each year and you own the property 50-50, the annual cash flow after tax benefits might be minus $10,375, which reduces the cash flow to holding this property to $200 a week, or $10,000 a year if you're wanting to make it round numbers. What this means is you need to look at the deal analysis, you need to look at your annual profit and loss, and then you need to look at the tax benefits and depreciation benefits of holding and owning this investment property to give yourself a realistic view of what the numbers are going to be on this deal every 12 months. So you might be able to accept $200 a week out of your pocket if you think the property is going to grow by $500 a week in capital value. Now, these things are not so linear. Growth is not on a linear trajectory, and cash flow is not always going to be $200 a week because repairs and maintenance pop up. I know for Emily and I, we have big repairs and maintenance bills and then nothing for a while. We even spent $20,000 recently on completely doing the gutters at our unit block in Coffs Harbour because, again, we're looking to own that property for the long term. And so we were happy to make a larger capital outlay with the view that we're holding the property for the next 10, 15, 20 years. And it's going to continue to give us cash flow over time. Yes, there might be some repairs and maintenance headaches. Yes, we're going to have some tenancies or vacancies pop up over time. But over the long term, we're expecting to see capital growth and ability to add value and boosted cash flow over time. Now we've gone through the 3 key areas in this workbook. The next thing I wanted to touch on was the value add. So in this example, you can see detailed numbers of a renovation project for around $30,000 on this $950,000 property. We might want to do a garage door repair, deal with some wood rot, gutters, drywall, kitchens, cabinets, flooring, plumbing, the list goes on. The great thing is here, you can put down expected numbers and costs for each of these items to work out your renovation budget. Now, if that's all too hard, we actually offer renovation services for our clients, our buyer's agency clients here in Southeast Queensland. We deal with projects as small as $5,000 all the way up to $100,000, focusing on value add potential and cosmetic renovations. So for every dollar we spend, we're looking to get a 2x return. Now, for a client doing a $30,000 reno, we charge an additional 20% in costs to manage that project for them. So the total cost for a project with us would be $36,000 in this case. And spending the money on all of these items, we're looking to get that 2-for-1 return. So we'd like an uplift from $950,000 into around the low 1 millions, all the way up to $1,075,000, depending on how large this budget was. The other great thing about spending money on renovations is it not only increases the capital value, but it can also increase your rental value. If you're able to add amenity like air cons, dishwashers, things that make people's life easier, as well as cosmetic appeal, so we're looking at the paint, the flooring, the carpet. If you can add both amenity and cosmetic improvements, you're going to significantly be able to increase your capital value, as well as increase your rental return on that property. Now, as a chartered accountant, Emily and I have done this for every single property we've put into our portfolio. Our first property, we added value to, we renovated, we put in some sweat equity. Then we went back to the bank and refinanced that project based on the higher valuation, pulled out equity and continued to go again. We did this with the Baby Queenslander, which was our renovation series here on YouTube. We then have done that with the triple Gable Queenslander and are doing a second level project now, spending around $500,000 to $600,000 on our own home to add significant value and use the equity in our own home to go out and buy more investments in the future. We then were able to buy the unit block in Coffs Harbour, and now Emily and I are eyeing off a motel purchase somewhere in Queensland or New South Wales for around $2 to $4 million to expand our property portfolio, to boost our cash flow, and to tackle something that we have our skill set in. Emily and I are really good at adding value through cosmetic renovations, process improvements and optimizing, and creating a better product to boost the rental yield and to boost the capital growth on the properties that we've purchased. So what I want you to do is head over to purposeproperty.com.au and download this free property investment calculator if you think it will be of use to you. You can run your deal analysis, your profit and loss, you can do your own tax effect accounting, and you can manage a renovation budget all in one place. The most important thing here is to take action. It's great to run the numbers on different deals and do your sensitivity analysis. And that's exactly what I've done as a chartered accountant, is run these numbers in detail, make a copy of the tab and run different scenarios and different situations. So do that for yourself, but you need to actually have an investment property to own and add value to and to grow your property portfolio. And that means taking action. If you're looking to buy your own home or an investment property here in Southeast Queensland in the next 6 months, make sure you head over to purposeproperty.com.au as well and book in a free strategy session with myself. We'll sit down, have a chat about your situation, chat about your long and your short-term goals, and how we can help you buy that next property here in the Greater Brisbane market. We're local area experts and we specialise here in roughly a 35-kilometre ring around Brisbane. So make sure you head over to purposeproperty.com.au to book in that session. Or you can always give me a call if you want to get in contact earlier. So thanks for sticking around to the end of this video. I hope you got heaps of value out of it. Drop a like on this video, subscribe to the channel, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.